In economics, inflation is a sustained increase in the general price level of goods and services in an economy over a period of time. When the price level rises, each unit of currency buys fewer goods and services. Consequently, inflation reflects a reduction in the purchasing power per unit of money, a loss of real value in the medium of exchange and unit of account. Within the economy, a chief measure of price inflation is the inflation rate, the annualized percentage change in a general price index, usually the consumer price index, over time. The opposite of inflation is deflation. Inflation affects an economy in various positive and negative ways. Negative effects of inflation include an increase in the opportunity cost of holding money, uncertainty over future inflation which may discourage investment and savings, and if inflation were rapid enough, shortages of goods as consumers begin hoarding out of concern that prices will increase in the future. Positive effects include reducing the real burden of public and private debt, keeping nominal interest rates above zero so that central banks can adjust interest rates to stabilize the economy, and reducing unemployment due to nominal wage rigidity. Economists generally believe that high rates of inflation and hyperinflation are caused by an excessive growth of the money supply. However, money supply growth does not necessarily cause inflation. Some economists maintain that under the conditions of a liquidity trap, large monetary injections are like pushing on a string. Views on which factors determine low to moderate rates of inflation are more varied. Low or moderate inflation may be attributed to fluctuations in real demand for goods and services, or changes in available supplies such as during scarcities. However, the consensus view is that a long sustained period of inflation is caused by money supply growing faster than the rate of economic growth. Today, most economists favor a low and steady rate of inflation. Low inflation reduces the severity of economic recessions by enabling the labor market to adjust more quickly in a downturn, and reduces the risk that a liquidity trap prevents monetary policy from stabilizing the economy. The task of keeping the rate of inflation low and stable is usually given to monetary authorities. Generally, these monetary authorities are the central banks that control monetary policy through the setting of interest rates, through open market operations, and through the setting of banking reserve requirements. History. Rapid increases in quantity of the money or in the overall money supply have occurred in many different societies throughout history, changing with different forms of money used. For instance, when gold was used as currency, the government could collect gold coins, melt them down, mix them with other metals such as silver, copper or lead, and reissue them at the same nominal value. By diluting the gold with other metals, the government could issue more coins without also needing to increase the amount of gold used to make them. When the cost of each coin is lowered in this way, the government profits from an increase in seigniorage. This practice would increase the money supply, but at the same time the relative value of each coin would be lowered. As the relative value of the coins becomes lower, consumers would need to give more coins in exchange for the same goods and services as before. These goods and services would experience a price increase as the value of each coin is reduced. Song Dynasty China introduced the practice of printing paper money in order to create fiat currency. During the Mongol Yuan dynasty, the government spent a great deal of money fighting costly wars, and reacted by printing more money, leading to inflation. Fearing the inflation that plagued the Yuan dynasty, the Ming dynasty initially rejected the use of paper money, and reverted to using copper coins. Historically, large infusions of gold or silver into an economy also led to inflation. From the second half of the 15th century to the first half of the 17th, Western Europe experienced a major inflationary cycle referred to as the Price Revolution. with prices on average rising perhaps sixfold over 150 years. This was largely caused by the sudden influx of gold and silver from the New World into Habsburg Spain. The silver spread throughout the previously cash-starved Europe and caused widespread inflation. Demographic factors also contributed to upward pressure on prices, with European population growth after depopulation caused by the Black Death pandemic. By the 19th century, economists categorized three separate factors that cause a rise or fall in the price of goods: a change in the value of production costs of the good, a change in the price of money, which then was usually a fluctuation in the commodity price of the metallic content in the currency, and currency depreciation resulting from an increased supply of currency relative to the quantity of redeemable metal backing the currency. Following the proliferation of private banknote currency printed during the American Civil War, the term inflation started to appear as a direct reference to the currency depreciation that occurred as the quantity of redeemable banknotes outstripped the quantity of metal available for the redemption. At the time, the term inflation referred to the devaluation of the currency, and not to a rise in the price of goods. This relationship between the oversupply of banknotes and a resulting depreciation in the value was noted by earlier classical economists such as David Hume and David Ricardo, who would go on to examine and debate what effect currency devaluation has on the price of goods. The adoption of fiat currency by many countries, for the 18th century onwards, made much larger variations in the supply of money possible. Since then, huge increases in the supply of paper money have taken place in a number of countries, producing hyperinflations, episodes of extreme inflation rates much higher than those observed in earlier periods of commodity money. The hyperinflation in the Weimar Republic of Germany is a notable example. Related definitions. The term inflation originally referred to increases in the amount of money in circulation, and some economists still use the word in this way. However, most economists today use the term inflation to refer to a rise in the price level. An increase in the money supply may be called monetary inflation, to distinguish it from rising prices, which may also for clarity be called price inflation. Economists generally agree that in the long run, inflation is caused by increases in the money supply. Conceptually, inflation refers to the general trend of prices, not changes in any specific price. For example, if people choose to buy more cucumbers than tomatoes, cucumbers consequently become more expensive and tomatoes cheaper. These changes are not related to inflation, they reflect a shift in tastes. Inflation is related to the value of currency itself. When currency was linked with the gold, if new gold deposits were found, the price of gold and the value of currency would fall, and consequently prices of all other goods would become higher. Other economic concepts related to inflation include deflation, a fall in the general price level; disinflation, a decrease in the rate of inflation; hyperinflation, an out-of-control inflationary spiral; stagflation, a combination of inflation, slow economic growth and higher unemployment; reflation, an attempt to raise the general level of prices to counteract deflationary pressures; and asset price inflation, a general rise in the prices of financial assets without a corresponding increase in the prices of goods or services. Since there are many possible measures of the price level, there are many possible measures of price inflation. Most frequently, the term inflation refers to a rise in a broad price index representing the overall price level for goods and services in the economy. The consumer price index, the personal consumption expenditures price index and the GDP deflator are some examples of broad price indices. However, inflation may also be used to describe a rising price level within a narrower set of assets, goods or services within the economy, such as commodities, tangible assets, financial assets, services, or labor. Although the values of capital assets are often casually said to inflate, this should not be confused with inflation as a defined term. A more accurate description for an increase in the value of a capital asset is appreciation. The Reuters CRB index, the producer price index, and employment cost index are examples of narrow price indices used to measure price inflation in particular sectors of the economy. Core inflation is a measure of inflation for a subset of consumer prices that excludes food and energy prices, which rise and fall more than other prices in the short term. The Federal Reserve Board pays particular attention to the core inflation rate to get a better estimate of long-term future inflation trends. Overall effects. An increase in the general level of prices implies a decrease in the purchasing power of the currency. That is, when the general level of prices rise, each monetary unit buys fewer goods and services. The effect of inflation is not distributed evenly in the economy, and as a consequence, there are hidden costs to some and benefits to others from this decrease in the purchasing power of money. For example, with inflation, those segments in society which own physical assets, such as property, stock, etc., benefit from the price value of the holdings going up when those who seek to acquire them will need to pay more for them. Their ability to do so will depend on the degree to which their income is fixed. For example, increases in payments to workers and pensioners often lag behind inflation, and for some people income is fixed. Also, individuals or institutions with cash assets will experience a decline in the purchasing power of the cash. Increases in the price level erode the real value of money and other items with an underlying monetary nature. Debtors who have debts with a fixed nominal rate of interest will see a reduction in the real interest rate as the inflation rate rises. The real interest on a loan is the nominal rate minus the inflation rate. The formula R equals NR approximates the correct answer as long as both the nominal interest rate and the inflation rate are small. The correct equation is R equals NI, where R, N and I are expressed as ratios. As an example, when the inflation rate is 3%, a loan with a nominal interest rate of 5% would have a real interest rate of approximately 2%. Any unexpected increase in the inflation rate would decrease the real interest rate. Banks and other lenders adjust for this inflation risk either by including an inflation risk premium to fixed interest rate loans, or lending at an adjustable rate. Negative, high, or unpredictable inflation rates are regarded as harmful to an overall economy. They add inefficiencies in the market, and make it difficult for companies to budget or plan long-term. Inflation can act as a drag on productivity as companies are forced to shift resources away from products and services in order to focus on profit and losses from currency inflation. Uncertainty about the future purchasing power of money discourages investment and saving. Inflation can also impose hidden tax increases. For instance, inflated earnings push taxpayers into higher income tax rates unless the tax brackets are indexed to inflation. With high inflation, purchasing power is redistributed from those on fixed nominal incomes, such as some pensioners whose pensions are not indexed to the price level, towards those with variable incomes whose earnings may better keep pace with the inflation. This redistribution of purchasing power will also occur between international trading partners, where fixed exchange rates are imposed. Higher inflation in one economy than another will cause the first economy's exports to become more expensive and affect the balance of trade. There can also be negative impacts to trade from an increased instability in currency exchange prices caused by unpredictable inflation. Cost push inflation. Higher inflation can prompt employees to demand rapid wage increases to keep up with consumer prices. In the cost push theory of inflation, rising wages in turn can help fuel inflation. In the case of collective bargaining, wage growth will be set as a function of inflationary expectations, which will be higher when inflation is high. This can cause a wage spiral. In a sense, inflation begets further inflationary expectations, which beget further inflation. Hoarding. People buy durable and/or non-perishable commodities and other goods as stores of wealth, to avoid the losses expected from the declining purchasing power of money, creating shortages of the hoarded goods. Social unrest and revolts. Inflation can lead to massive demonstrations and revolutions. For example, inflation, and in particular food inflation, is considered as one of the main reasons that caused the 2010-11 Tunisian Revolution and the 2011 Egyptian Revolution. According to many observers, including Robert Zoellick, president of the World Bank, Tunisian President Zine El Abidine Ben Ali was ousted. Egyptian President Hosni Mubarak was also ousted after only 18 days of demonstrations, and protests soon spread in many countries of North Africa and Middle East. Hyperinflation. If inflation becomes too high, it can cause people to severely curtail the use of the currency, leading to an acceleration in the inflation rate. High and accelerating inflation grossly interferes with the normal workings of the economy, hurting its ability to supply goods. Hyperinflation can lead to the abandonment of the use of the country's currency, leading to the adoption of an external currency. Allocative efficiency. A change in the supply-demand for a good will normally cause its relative price to change, signaling the buyers and sellers that they should reallocate resources in response to the new market conditions. But when prices are constantly changing due to inflation, price changes due to genuine relative price signals are difficult to distinguish from price changes due to general inflation, so agents are slow to respond to them. The result is a loss of allocative efficiency. Shoe leather cost. High inflation increases the opportunity cost of holding cash balances and can induce people to hold a greater portion of their assets in interest-paying accounts. However, since cash is still needed in order to carry out transactions, this means that more trips to the bank are necessary in order to make withdrawals, proverbially wearing out the shoe leather with each trip. Menu costs. With high inflation, firms must change the prices often in order to keep up with economy-wide changes. But often changing prices is itself a costly activity, whether explicitly, as with the need to print new menus, or implicitly, as with the extra time and effort needed to change prices constantly. Business cycles. According to the Austrian business cycle theory, inflation sets off the business cycle. Austrian economists hold this to be the most damaging effect of inflation. Artificially low interest rates and the associated increase in the money supply are said to lead to reckless, speculative borrowing, resulting in clusters of malinvestments which eventually have to be liquidated as they become unsustainable. Economists such as Gottfried von Haboler, Milton Friedman, Gordon Tullock, Brian Kaplan, and Paul Krugman have argued that the theory is incorrect. positive labor market adjustments, nominal wages are slow to adjust downwards. This can lead to prolonged disequilibrium and high unemployment in the labor market, since inflation allows real wages to fall even if nominal wages are kept constant. Moderate inflation enables labor markets to reach equilibrium faster. Room to maneuver. The primary tools for controlling the money supply are the ability to set the discount rate, the rate at which banks can borrow from the central bank, and open market operations, which of the central bank's interventions into the bonds market with the aim of affecting the nominal interest rate. If an economy finds itself in a recession with already low, or even zero, nominal interest rates, then the bank cannot cut these rates further in order to stimulate the economy. This situation is known as a liquidity trap. Mundell-Tobin effect. The Nobel laureate Robert Mundell noted that moderate inflation would induce savers to substitute lending for some money holding as a means to finance future spending. But substitution would cause market clearing real interest rates to fall. The lower real rate of interest would induce more borrowing to finance investment. In a similar vein, Nobel laureate James Tobin noted that such inflation would cause businesses to substitute investment in physical capital for money balances in their asset portfolios. But substitution would mean choosing the making of investments with lower rates of real return. The two related effects are known as the Mundell-Tobin effect. Unless the economy is already overinvesting according to models of economic growth theory, that extra investment resulting from the effect would be seen as positive. Instability with deflation. Economist S.C. Siang noted that once substantial deflation is expected, two important effects will appear, both the result of money holding substituting for lending as a vehicle for saving. The first was that continually falling prices and the resulting incentive to hoard money will cause instability resulting from the likely increasing fear, while money hoards grow in value, that the value of those hoards are at risk, as people realize that a movement to trade those money hoards for real goods and assets will quickly drive those prices up. Any movement to spend those hoards once started would become a tremendous avalanche, which could rampage for a long time before it would spend itself. Thus, a regime of long-term deflation is likely to be interrupted by periodic spikes of rapid inflation and consequent real economic disruptions. Moderate and stable inflation would avoid such a seesawing of price movements. Financial market inefficiency with deflation. The second effect noted by Siang is that when savers have substituted money holding for lending on financial markets, the role of those markets in channeling savings into investment is undermined. With nominal interest rates driven to zero, or near zero, from the competition with a higher return money asset, there would be no price mechanism in whatever is left of those markets. With financial markets effectively euthanized, the remaining goods and physical asset prices would move in perverse directions. For example, an increased desire to save could not push interest rates further down but would instead cause additional money hoarding, driving consumer prices further down and making investment in consumer goods production thereby less attractive. Moderate inflation, once its expectation is incorporated into nominal interest rates, would give those interest rates room to go both up and down in response to shifting investment opportunities or savers' preferences, and thus allow financial markets to function in a more normal fashion.